Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Zandi has been on fire out on Twitter writing this up. And, he's got the fam photo on Twitter. And you can tell, your youngest daughter, Mark Zandi, Daffodil, your youngest daughter, just look, what is it about the youngest daughter, Dr. Zandi? They're trouble.
Yeah, I hear you. But all my kids are enchanting, Tom. But you're right.
They're enchanting. And then there's Daffodil, the youngest daughter. How's the inflation at the Zandi house right now? Into this report, what do you see viscerally on inflation?
Abstracting from the ups and downs and all around, it feels like consumer price inflation is 3% year over year, which is, it's back closer to the Fed's target, but not quite there. On the CPI, the Fed's target would be 2.5%. The thing that, obviously is a bit more worrisome is where we're headed. And, if we had this conversation 3 months ago, I said we'd be back to the Fed's target by the spring. But, with these tariffs, it doesn't feel likely at this point.
So, Mark, is that a valid concern for this marketplace that these tariffs will result in, meaningfully higher inflation?
Yeah, obviously it depends on how high the tariffs go, how broad-based they are, how persistent the tariffs are put in place. But feels like we're going to get some real tariffs here for an extended period. Here's a good rule of thumb. For every percentage point increase in the effective tariff rate, that adds 0.1% to consumer price inflation over the subsequent year. So we go from 3% effective tariff rate where we were before, President Trump, to let's say 10%, and that feels like where we're headed. That adds 0.7% to CPI inflation in the coming year. That's meaningful.
Can you calculate where we are in that 3% statistic now? Are we at a Zandi 4.2% this morning, or on our way to 10%? Do we know where we are?
You mean, Tom, with what's already been implemented?
Yeah, what's already been implemented. The Zandi.
I think we're kind of closer to 4.5. You're right. 4 point. I have to do the calculation, but 4.2 sounds about right to me. Yeah. So we've gone from 3 to 4.2. Yep. So we got a ways to go here. But, the real thing is the reciprocal tariffs, right? If that's actually implemented early April, that's the schedule at the moment.
Yep.
That would get you over 10. That would get you over 10 on the effective rate.
And what would such an environment do to your GDP outlook?
Weaker. Tariffs they result in some combination of higher inflation, higher interest rates, or weaker economic growth. Pick your poison. It's, if you don't get the inflation, you're going to get the weaker growth. If you don't get the weaker growth, you get the inflation or higher interest rates. And all the above is already happening in anticipation of the tariffs, right? You can see inflation expectations are up. The Fed's not moving now, and they're telling us it's because it's economic policy code word for tariffs, and growth is slowing. So all the things that we think tariffs are going to do, they're doing in advance of actually the tariffs coming into place, because we're all anticipating it.
But Paul, to your good question here, I'm sorry, it comes down to granularity. Daffodil needs a new pair of Doc Martin Mary Janes at the Zandi household.
I don't even know what that is. That sounds scary.
They're leopard. They're leopard, and they're incoming, and they're going to have a tariff on them because they're made in England.
Sure, everything.
Everything micro granular is going to be there. Mark Zandi with Moody's with us. We're going to talk to him after this inflation report. There's a lift to the market today. Paul, am I right? It's a tentative lift?
We were here, same place yesterday, Tom, before we got some of the tweets started coming out. So, Mark, just at the inflation reading, the CPI, we got a little bit better than expected in terms of lower inflation. We know it's backward looking, but what do you take away from the CPI print today?
Well, that's on the face of it better. It's one of these things where you have to go to the second and third significant digit. I think our estimate was like 0.25, so it would have rounded up to 0.3. So maybe Yeah, I don't know. We'll have to do the calculation, but that's how much we're parsing the numbers here. But I think bottom line, abstracting from the vagaries of the monthly data, we're kind of, as I said earlier, still stuck around 3%, and that's where we're going to stay for a while until we get some clarity around, and hopefully these tariffs go away, sooner rather than later.
Mark, where are you on a Fed rate cuts through the year? I mean, everybody seems to be 3-ish guessing, but. You don't guess, Mark. So what's your feeling and what they'll do.
I tell you, Tom, I'm confused. I mean, so is the Fed, right? Because what do you do with the tariffs? I mean, it raises inflation, it weakens growth. So how do you respond? And they're saying, well, we don't until we get some clarity, any kind of clarity around what's going on and how it's all going to play out. I mean, in my baseline kind of official forecast, I have 2 rate cuts towards the end of the year. It's going to take until the second half of the year before they get enough clarity to start moving again. Right. But ultimately, I do think the tariffs are going to be, more growth negative than inflation positive, right. I think, at the end of the day.
Dr. Zandi.
And that may mean more rate cuts.
Dr. Zandi, thank you so much for joining us today. Mark Zandi, writing for Moody's, always very strong out on Twitter. Look from there for some very important notes. Futures up 74, a lift to the market. Not going to make too much about it. Paul and I are waiting for the next headline. Long ago and far away, a wonderful person who was a great supporter of mine in the early years, that's Stan Freberg, was Fred Bergsten. And he was at what became the Petersen Institute. The toughest job was to pick up from Fred, and that is what Adam Posen has done with grace, to say the least. The only one working harder than Adam Posen at the Petersen Institute is Chad Bohn, who hasn't had a day off since time began, as we look at this trade mess we're in. Bonus round, Adam Posen is expert on the German political economic experiment. Dr. Posen, thank you so much for joining us today. If Doug Irwin up at Dartmouth was to rewrite his history of the tariffs and all, what would Adam Posen be writing right now?
Thanks, Tom, for having me back. And everyone should read Chad Bohn and Doug Irwin's new piece in Foreign Affairs that just came out on tariffs. Doug has made the point repeatedly, there are charts on the IPIE website, that this is historically unprecedented. You really have to go back 100 years, 90 plus years to Smoot-Hawley to see anything like this in terms of the size, scope of tariffs. But even more so, this is much more uncertain, as he's pointed out, Chad, Mary Lovely, and I, in various ways. This is an exercise of discretionary presidential power. I'll leave aside the constitutionality or the issues of politics, but just from an economic point of view, in the past, when there have been large moves of tariffs, it's mostly been in the US because Congress has authorized them. This is being done day to day, or as Justin Wolfers joked, intraday tariff changes on presidential whim. And that creates even more uncertainty. Doug would say we're in new territory, and it ain't pretty.
Professor Irwin joining us from Dartmouth. We'll do that on Friday here on Bloomberg Surveillance. Dr. Posen, as simple as I can, Krugman, with his Nobel speech, would look at the microeconomics of the moment, and there'd be a lot of fancy Adam Posen talk. Forget about it. What's the deadweight loss for our audience right now, our audience in Winnipeg, our audience in Wisconsin? What's the deadweight loss given all of this?
On the order of $1,000+ a year for the average household, higher for lower income households. And that doesn't include the hits to retirement funds or the going forward, the lower opportunities because investments getting chilled. Direct hit is on the order of $1,000 per household. You could argue if the tariffs stick, or if they put on the across the board tariffs, it gets closer to $1,500 to $2,000 a household.
Wow. Adam, I'm hearing the recession word more and more over the last several weeks. Is that in your calculus anywhere?
So I've been saying for a while now that I was expecting a large boom and then Fed-induced bust under Trump, but I always held out that this was a radical enough program that it was bimodal, meaning, again, simple talk. It wasn't going to end up in the middle. It was going to be one of two outcomes. I have the recession probability only at like 15+%, so no different than anybody in a normal time. But what I kept saying, and this may have been a hedge, but it turns out to be reality, was if Trump administration overdid it on tariffs, on migration, on fiscal follies, that would swap us into the into the recession camp. So I've upped my recession subjective probability to 30%. I still think it's more likely than not we get a boom bust, but you throw in the geopolitical shock, which is enormous and which really changes the game for Europe and for everybody. And then you throw in the fact that Doge shutting down Department of Education, USAID, I may not like, but I expected that. Throwing a miasma of similar uncertainty over all government contracting, all government workforce has huge effects. So yeah, the recession risk has gone way up.
From some of President Trump's policy people, we're starting to hear more and more discussion that what the president is aiming to do is to kind of reshape the U.S. economy to bring more manufacturing back to the U.S. And some folks are concerned that that's kind of counterintuitive to what we've experienced over the last 50, 60, 70 years of more of a globalization and at least in the U.S. economy, a focus on the services part of the economy. How do you view this potential policy shift for the U.S.?
I view it as a very mistaken policy shift for two reasons. First, in line with what you said, increasing manufacturing employment or literal production within U.S. borders isn't necessarily a good thing. If they want to force Americans to do rare earths mining or production of generic pharmaceuticals, those are steps backward for U.S. workers. And so you would either have to vastly overpay, which then makes it totally uncompetitive internationally and totally an inflation for the domestic households, or you're just subjecting American workers to bad jobs that we're too well endowed and skilled to do. The second reason, though, is it's just not going to work. My colleague Robert Lawrence, who's at Harvard and Petersen Institute, had a book out last fall called Behind the Curve, which I think established brilliantly that even if you fantasize about going back to 1958 and a bunch of guys getting to be big breadwinners for their families with no education, which there's reasons you might like that, it's just not going to happen because the total taste of the world and the movement of technology for globalization has made it impossible to create large numbers of manufacturing jobs of that sort. So it's a bad goal and it's not going to work.
Well, we continue with Adam Posen, the Petersen Institute. Again, Doug Irwin with us on Friday from Dartmouth. Brij Khurana coming up as well from Wellington. Good morning across the nation. Good morning, 92.9 FM in Boston and on down to 99.1 FM in Washington, D.C. as well. Adam, we got a good amount of time here, but I want to slip this in. I think it's so important. Robert Zoellick is somebody that I think more than anyone takes our international economics and our sense of constructive globalization and folds it into American business. He's been on fire recently. What's the message you've taken from one of our trade giants?
I agree. Bob Zoellick is a hero to me and is a statesperson of the longtime ideal for the U.S. And he integrates diplomacy, history, security, and economics like nobody else, pretty much.
Okay, here's the sentence, Adam. Here's the sentence. Yeah. The zero-sum logic reverts back to a view in the 19th and 18th centuries called mercantilism. That's from Zoellick. Is that where we are this morning?
Yeah, that is where we are. I mean, when you listen to the President Trump, give the rant he gave yesterday about Canada was very unfair, EU is terribly unfair, on and on and on. Again, I don't presume to talk psychology, but as a matter of economic facts, it's just a completely self-deluded view. It's not true on the facts. But it only makes sense if you have the mercantilist blinders on, which means you see trade as negative sum, not even zero sum. And you see, again, going back to the previous comment, that only making physical stuff matters. And this is just not true. You can make national security arguments, and Bob would allow for this too, that specifically with respect to China or in a given industry like semiconductors, you don't want to have too much concentration risk, dependence on a particular thing.
Right.
Even there, though, you don't want to be putting up barriers around so you're dependent on some American company that happens to be a friend of the president's and is overly protected, too big to fail, and makes planes that drop out of the sky or semiconductors that don't really work, right? So, this is a huge step backward. Where I think Bob is much more articulate than I'm being is the international systemic part of this.
Right.
That there is a feedback loop for the U.S. And this is what I think Trump and Bissett and Hassett, whether they know it or not, whether they think it's a means to an end or not, I don't know. But they're ignoring that the U.S., as I argued in Foreign Affairs a few years ago, was chairman of the club and therefore got to set the rules, got to self-deal, got to determine who was members, but it had to behave within some reasonable set of rules and provide the club some benefits. And once the U.S. just says, I'm a member, and a member may even leave the club goes on without you.
YouTube live chat. Thank you out on YouTube. Huge audience this morning. Paul Sweeney. Tom, you need a beard like Adam Posen.
Oh, there you go.
I mean, there it is. Adam's not shaving until the Red Sox are in first place. We'll see when that happens. Continue, Paul.
Sustainably in first place.
Sustainably in first place. Hey, Adam, I think most Americans would agree that this U.S. government, federal government, is bloated. It's bureaucratic, too much red tape, all that good stuff. Is Doge the way to address that?
Not so far. I mean, Paul, you're right. Most Americans would agree, and there's certainly a point there. I think what I tried to say to people before Doge got started was the issue with government isn't so much waste fraud. It's that because of politics, every task has 17 key performance indicators, has 17 different constituencies, and then gets funded to 75, 80% of what it needs to do that at best. And so what you needed to do, and this is the place where I think an outside government reform effort could have been good, is saying, let's prioritize, let's not let the accumulation through the years of individual little congressional or special interest moves determine our budget, determine our priorities. So again, I'm not in favor of getting rid of education. I'm totally against getting rid of USAID, but in a sense, as a process, if they had just come in and said, we're taking out this whole department and we're doing this instead, that's okay as a process. It's not okay to create terror across the workforce. It's not okay to make government contractors not get paid for stuff they've already done and not know what they're going to get. It's not okay to blow up whole ecosystems just because they're in government. And most of all, if you did it by priorities, things like energy grid, nuclear power experts, air traffic control, NOAA and NIH directly into world R&D, those things would have been spared because they're directly helpful to the economy.
Adam, I got to do an audible here before we let you go. And, we all know in academics that you are expert on Germany. Let's go back to June of 1963 when time stopped. President Obama redux JFK's an unbelievable speech in the heart of the Cold War. Mike, ready for my German, Paul? Ich bin ein Berliner. I nailed it. Okay, not even close. I got a D- there, but the professor got hockey tickets, so it worked out. Adam Posen, you are expert on this. Is this a Germany, in this new Germany? Would Konrad Adenauer and Willy Brandt, would they recognize it?
They'd have trouble, and that's a good thing. They would have trouble imagining a Germany that pursues security without being totally reliant on the U.S. They would have trouble imagining a Germany that does use its fiscal capabilities more than not. And they would have trouble with a Germany that explicitly is going to rearm. But I think it's the right move for Germany. I mean, you've seen the meme on Twitter, Tom, that Chancellor Merz, incoming Chancellor Merz, is shown with the big smile on his face, and the blurb is, when you realize you can borrow just like any other European country. this is genuine progress. It's sad that it took the threat to NATO and the threat from Russia and the US to make it happen. But I think this is a genuine leap forward, as opposed to previous Chancellor Scholz's Zeitenwende, changing time. This is the real one.
Adam,
right now.
Generous conversation. Thank you so much. Folks, look to Chad Bone and the rest at Petersen Institute for terrific, thought-provoking essays in the chaos of where we are now. As we've been saying for days, if not weeks in this chaos, the bond market matters, Paul, to the stock market. It's that simple.
Yep. We got a pro in here joining us today, Brij Khurana. He's Senior Managing Director and Fixed Income Portfolio Manager at Wellington Management. Joining us here in our Bloomberg Interactive Broker Studio. Brij, talk to us about, first of all, what did you think of the CPI print? It came in a little bit lower than expected. What are you seeing in the bond market?
Yeah, so I just going through my notes right now. It was universally positive, I would say. So two things that were concerning last time. Core CPI, if you take out shelter, was almost 0.5% month over month, which was the highest it was in 2 years.
Okay.
That fell back down to 0.2%, so that's good. And then core services, which was what the Fed really cares about because that is tied to the labor market, that was 0.5% as well last month over month print. That came down to 0.3% month over month. And that was driven largely by transports and airlines. But point being that I think this is a welcome sigh of relief for the Fed after that very spicy print. I can see why the stock market likes it, because I did think this was coming into this event. This was going to be one of the most impactful CPI prints in the last few years, just because of the equity volatility we've seen. And, you know, the market has been somewhat buoyed by the fact that the market's now pricing in almost 3 cuts for the Fed throughout the rest of the year. And so in my mind, it was a very important print. And you know, I'm not surprised stocks like it.
That was brilliant, except Wednesdays were note-free at Bloomberg Surveillance. Nobody, Monday and
I'll put
Tuesday.
it down then. Yeah.
Monday and Tuesday, we got notes. Put the damn notes aside, Paul.
So what have you been seeing in the bond market over the last several weeks of all this volatility, all the increased trade talk, the uncertainty to economic growth, the uncertainty as it relates to potential impacts on inflation? What's the bond market been saying?
So you have definitely seen a decline in yields in the U.S. In particular. Actually, it's been much higher yields abroad.
Yeah.
You know, I think the U.S. bond market is really responding to the uncertainty in the economy, the sudden stop you might see from whether or not it's tariff policy, but also immigration as well. And, you know, but I think what's interesting to me is that I look at the inter-sector performance between cyclical stocks and defensive stocks. To me, it's been one of the best leading indicators for bond yields. You know, as the market's worried about the cyclical companies, then bond yields generally fall. And, you know, what's been interesting is those stocks have been almost 35% off their peaks, cyclicals relative to defensives. And bond yields are still, you know, about 40, 50 basis points above where we were in August. And so it has been a notable decline in bond yields. I guess just given the uncertainty in the economic outlook, I would have thought it would have been more, and particularly at the back end of the curve. Most of the move has been really repricing the Fed, which, to be honest, you know, this is welcome news. And the market's pricing in 3 cuts roughly. I think that's pretty fair, but you know, I'm not sure that there's going to be a lot more than that.
From December 22, off the Bloomberg Fixed Income Corporate Total Return Index, what a recovery in price we have. I don't think it's nearly out there in the zeitgeist now at all, that it's been price up, yield down for bonds. But we're not back to the price peaks that we saw pre-COVID, and we're certainly not back to the great moderation vector of success that bonds lived. Do you visualize out there just getting back to the peak of price that we had years ago? Or can, heaven forbid, get back to the Wellington PIMCO vector that we saw in the Great Moderation? Can we see that much appreciation?
You know, well, I would say this. You know, it's been a really tough, you know, returns for bonds over the last, you know, decade now. I think it's the worst performance for bonds over, you know, a few decades, and on a real basis.
Thank you for saying that. Nobody else will say that. I appreciate that.
Yeah, on a real basis too, and on an inflation adjusted basis, it's, you know, you're back to the mid 2000s in terms of total returns for bonds. Now, what I think is different right now is that, you know, we are in an environment where we've had so much fiscal stimulus since the pandemic. We got to all-time low bond yields, and now we've had, you know, running deficits of 6 to 7%. And so the economy hasn't been very responsive to high interest rates because fiscal stimulus has been uncorrelated with the other parts of the economy. And so I guess the point I would make is we do seem to be moving into an environment where fiscal stimulus is not going to be what it was in the last few years. And then you really bring up the question of whether or not, are real policy rates or are real rates that different than they were, before the pandemic? And I would argue we're seeing less labor force growth. We're seeing, similar productivity growth than we saw pre-pandemic. That means that the neutral rate for bonds is not that much higher than we really saw prior to the pandemic, even if we're in a higher inflation regime.
Did you take notes on that, even though Wednesday's note-free?
Note-free.
I forgot to take notes.
There was no notes involved in that one.
Brij, how much credit risk are you guys taking these days in your portfolio, and has that changed over the last several weeks and months?
Well, since I've come on your show last time, I think this is the first time that actually spreads are higher. Okay. I still think, but they were coming off a very, very low level. So high yield spreads are currently around 310 basis points. I think that's getting to be much more fair levels than we've seen. But once again, as I said, I think the market's been really focused. One of the reasons credit spreads have been so tight has been just this amount of fiscal stimulus. And I also think, you were talking about trade earlier. I do think there's this unappreciated aspect to trade, and how much surpluses have been from abroad have really come into U.S. assets, both in U.S. equity markets and U.S. credit markets. And so, if we're really trying to change that paradigm of lower trade deficits globally, that should mean higher risk premium when it comes to credit markets and lower equity valuations as well, which is what we've started to see, at least in the last month or so.
Brij Khurana with us with Wellington. Thank you for that fixed income discussion.
Appreciate
That's really good about the 10-year struggle that fixed income has had.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
David Sowerby front-running Bloomberg Surveillance this morning with Ancora Advisors. And David, you do the math. The average stock from its peak down 20%. David Sowerby, are we in a bear market?
We're in a correction. Certainly, the market's down 10%. I like to look at the average or median. Now it's coming close to a bear market. And if we throw in small and mid caps, the average stock is about 25% off its own 52-week high. And if you look at investor sentiment, it probably puts us pretty close to a correction/bear market.
So, David, what are you telling your clients these days? Try to find the names you like, because now you can get them at a lower price, or are we just kind of sitting on the sidelines here a little bit?
Well, Paul, maybe this isn't the best CFA term, but you grind through it.
Yep.
The average intra-year market sell-off for the last 75 years is about 14%. So we're right there, or close enough. Now, from a contrarian perspective, you can't call a market bottom, but when sentiment gets unduly bearish, and it's there now, if you look 12 months out, 11 out of the last 12 times it's gotten this bearish, the market's higher, and the average return over the next 12 months is 20%. I don't know if it's going to be 20%, but I like those odds, knowing I make my most money when I run against the herd and I'm a contrarian, which is more what you need to be today.
What types of securities would you maybe dip your toe into and start looking at this stage?
It's always got to start with free cash flow on a valuation basis, free cash flow margin, who's growing the dividend, 10% or better. If you look at the filings for the mutual fund I manage, a travel name, Wyndham, is off 20% from its 52-week highs. And we're not talking about $500 a night Midtown prices. We're talking about La Quintas at $100 a night. It favors the middle market traveler. Wyndham has a very strong balance sheet, good recent earnings numbers. There's a travel stock that's down 20% from its 52-week high. I think that's an example. But if you find the companies that are generating good free cash flow margin above 12%, that's a good starting point.
David, we got some interesting and maybe troubling earnings news yesterday from a couple of industries. One, the airline industry, companies across the board cutting their forward outlook. We had a broad-based retailer like Kohl's do the same. What's your view? That kind of reflects that maybe the consumer is weakening a little bit due to some of the recent uncertainties out there. How do you view the consumer?
Paul, I think the adage in my career as an investor is never underestimate the health of the U.S. consumer, that they defy gravity. And if you look at household balance sheets, what the average mortgage rate is at around 4%, consumer free cash flow after they pay their bills, I think it's still a better than average time to be a consumer. What they don't like, what businesses don't like as well, is uncertainty.
Yep.
And that's an overused term in the last 2 weeks. But I was at an investment conference last week. 500 companies presented. The ones I sat in on, everybody got asked the tariff question. 8 out of 10 said it leads to uncertainty, and it's probably a hit directly or indirectly on earnings.
Yep. David Sarby with us this morning with Encore. We continue right now with him. A good conversation here. And as you mentioned, the Wyndham WH down the cap. We're not going to do Apple with David Sarby. David, you have a vista like no one we speak to into Michigan and over to Windsor, Ontario, up into Ontario, and then down the Mississippi River, down into Kentucky, down the interstates as well. Translate the angst you see on our auto tariff war.
The auto companies have been very specific to the administration that this is a bad policy, a hit, violates the free trade agreement, whether it's NAFTA, U.S., Mexico, Canada free trade agreement. It violates long-term strategies for supply chains. The car companies are in much better shape today, Tom, because they are better capital allocators, better generators of free cash. We're not helping them by instituting tariffs, and what it ultimately gets passed through to the consumer and the number of weeks you'll have to devote income to pay for a new car. It's not good for the manufacturing renaissance that's been taking place in my home state of Michigan for several years.
Being in Michigan, David, give us a sense of just kind of what the folks up in that part of the country, how they're feeling about the trade. I guess we have to call it a war skirmish between the U.S. and Canada. You guys are right geographically on the front lines there.
I may be the only guest in Bloomberg who can go south to Canada.
There you
Windsor.
go.
Now, no surprise, Michigan is the largest trading state with Canada, particularly Ontario. We're building this spectacular Gordie Howe Bridge from Detroit to Windsor. We'll have fewer passengers and freight hauling if we make these tariffs more permanent. It's just simply bad Econ 101. I wish the president would channel more Ronald Reagan or Bill Clinton, and unfortunately not channel his Herbert Hoover when it comes to trade.
David, give me an auto company or a manufacturing company down south of Detroit that you think has been pretty beat up right now. You mentioned Wyndham. Okay, it's hotels, great. But, I'm thinking Borg Warner, except Borg Warner hasn't done anything for a decade. Give me an auto company that's sour be ready, that's been beat to death.
I think, though I don't own it, I think GM is interesting. GM had a very good investor day not too long ago where they talked about capital allocation, less CapEx on EVs, more growth, returning it to the shareholder, better free cash flow for GM. I know it's the biggest name of the group, but I think GM is doing some very good things from a capital allocation standpoint.
Okay, that's great. And I get it. From COVID, they're doing double-digit return. They're up 19% off the mat of COVID, but the 10-year track record's single-digit. Do you see a new capital discipline there where we can look for nominal GD plus X beeps out of auto in Canada and America?
You can if you adopt the right policy. And I think the car companies are much better at spending their free cash than they were when they were making silly acquisitions decades ago. And now, more importantly, returning cash to the shareholder, either with buybacks or dividend growth, where maybe too much CapEx was thrown into autonomous vehicles and electric vehicles, which consumers are reluctant to buy.
Tom, we're getting close to opening day, which means we have to ask David Sauer about the Atlanta Braves and investing in the Atlanta Braves, Tom. David, what do you think?
Well, it's a name I gave you a couple weeks ago. We still own it. It's the John Malone spin out, like so many successful John Malone spin outs. He's been buying the stock. It's not just the team, it's the franchise, it's the stadium, it's mixed use retail, it's a small cap underfollowed stock. And I've always thought that you make your best money in underfollowed spin out small and mid cap stocks.
David Sowerby, thank you so much for the encore. Appreciate the note, particularly earlier this morning that we saw from David Sowerby on the average S&P from its individual peak is down 20% as well.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now, Callie Cox, to get the markets open here. We'll come back with her as well, Chief Market Strategist, Ritholtz Wealth Management. Callie, I can't stand, you write a research note, which I'm forced to read, it's so smart. And the problem I got is you break down this idiocy around the 200-day moving average, which I don't believe in, folks, just so you got it. What do we get wrong about in the media about the certitude of analyzing the 200-day moving average?
Well, Tom, I'm on the other side. I actually think that there is some signal around the 200-day. And I want to be clear, I'm not a technician. I don't look at many lines on charts. But when you're looking at the major moving averages, there has been a lot of resistance and support around the 200-day, especially in sell-offs. And unfortunately, we broke it. We actually broke it on Monday. So I call it the danger zone. I think that might be a little dramatic at this point because I would love to see the stock market or the S&P reclaim that. But for the moment, now that we are below the 200-day, I'm a little more worried about where this could go.
Tom, as you may recall, Callie is a proud graduate of the University of North Carolina, and her Tar Heels are playing today against Notre Dame in the ACC tournament at 2:30. So if you're planning on getting in touch with Callie around that time, she may not be available.
It may not be available.
She may not
be able to understand.
Callie.
I knew this was coming. I knew this was coming. And these are important games. We got to make it to March Madness.
Got to make it. So, yeah, and I think the networks want North Carolina there as well. Callie, the last several weeks on this sell-off here, has it seemed orderly to you, reasonable to you, part of maybe a healthy pullback in a market that maybe wants to work higher if earnings come through? How do you think about the last couple of weeks of trading?
I think it has been a bit orderly, but in a disorderly way. And what I mean by that is that we've seen the bulk of losses in tech stocks. I mean, tech coming into this year has had an astounding 2-year run, which was great. You know, if you're a tech investor, you were happy up until the beginning of this year. But we've seen a lot of those tech shares that have done so well roll over in the past few weeks. And to me, that says that there's a bit of a cooling off here. It's not necessarily the sell-off we're seeing isn't necessarily a reflection of fundamentals. But at the same time, what worries me is that we are seeing some weakening and some cracks widening in the job market. So in a way, I like the fact that this has been a little disorderly. And again, I'm not, I don't love a sell-off where, you know, our stomachs are turning and our anxiety is rising. But the fact that it's been a little uneven has comforted me a bit.
I remember the comedy of we're in an intermediate bull market or intermediate trend and all that. Callie Cox, have we broken the bull market? I'm not hearing that within the zeitgeist. Is the bull market over?
I don't think you can say that until we see layoffs surge definitively. Because, I mean, Tom, you're an orator of history like I am. You know that bear markets often overlap with economic recessions. And if you're waiting for a recession, you need to watch for signals in the job market. And I don't think we're seeing that yet, even though the trend is turning that way. We might be where we were several months ago where hiring is coming down, but companies may hold on to workers, not necessarily lay them off en masse.
Callie, one of the questions is, do we buy the dip? And I saw Citi, their trading desk, out with their note. They're saying, don't buy the dip, but it was almost between the lines, just yet. We're not quite there. How do you guys think about it?
Well, we serve long-term clients at Ritholtz, so our job is a little bit easier here. I mean, over time, we've seen over and over again that dips it's been smart to step in and buy the dips, especially around, this negative 10% correction level. But again, our clients are looking for over years and years and years. And of course, we believe that the story for the US economy can still thrive because markets ultimately grow on earnings, economy, and innovation. But at this moment, if you're looking over the next week or month or so, I would get a little more defensive here. We're still trying to figure out what this policy story could look like. We're trying to figure out the extent of the job market damage. We got data today showing inflation is still quite tame. I just wouldn't try to be a hero in this environment. I wouldn't be the one trying to make big, bold trades.
You say you got a long-term perspective, Callie, as well. Help me here with the utilization of bonds. We've got people saying finally bonds have value. Do you buy it, or does equities, is there still enough growthiness in equities?
Well, I think at this moment, again, if you're looking over the coming weeks and months, you'll probably find some comfort in buying up those quality bonds, right? I'd say we're in a classic growth scare right now. We haven't seen a full slate of data that proves that, we're in a full-blown economic crisis, but the trends are turning the wrong way. And when you're in an economic downturn, treasuries are the classic sanity hedge, and they've proven to be that during this growth scare. So within the fixed income market, look at quality, maybe look a little bit longer term. We haven't seen that hedging activity be as strong as it has in past growth scares, but at the same time, treasuries have risen on the back of the sell-off.
So, Callie, how do you think about valuation here? Again, we've had this little bit of a correction here, roughly a 10% pullback in the S&P 500. Is there a valuation call to be made here, or you don't even kind of go there? Again, I know you guys are long-term, but a lot of folks they tend to look for some entry points, and valuation is one of the data points they look at.
Right. I think valuation matters a little bit less in this environment, and valuation matters, but you have to view it in context. I mean, right now, the S&P's valuation is still quite high historically, but a lot of that is because we've seen tech shares do so well over the past 2 years. And unsurprisingly, they're the part of the market that's been selling off the hardest. So I think if you're taking any lessons from valuation here, it's to, look toward those stocks that are a little more fairly valued in this environment. Stocks that hug their earnings a little bit closer than the tech and growth shares of the world. Right. We believe in value a lot at Ritholtz because we try to prioritize stability and consistency. But I think right now the lesson is not to take valuation at its face, but to look within your portfolio and understand where there are valuation differences.
Callie, thanks so much. Callie Cox, Ritholtz Management today. Greatly appreciated.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
This is an important conversation right now. Leland Miller's been a little busy. He's with China Beige Book, and he has been advising on China economics to the Trump administration in a broad sense. He's not able to talk about those specifics, but we're thrilled he could be with us today. Leland, you are adult at guessing China GDP. Is it a legit 5%?
Absolutely not. But it doesn't matter. I mean, they come out with numbers and say it's, whatever numbers they have, and they say it's 5%. The market buys it. You get 2 op-eds from somebody saying we're skeptical. But each and every time the market basically buys whatever they put out, regardless of the evidence. So we're going to see more of that into the future.
Are we going to see more tit for tat within a zero-sum economics?
That we will definitely see. I mean, we're entering trade war time, obviously. There's tariffs coming from every direction. And I think it's important to separate what's happening with China from what's happening with the rest of the world, because I think there's a different discussion around economic imbalances in China, which are not even the focus of the current tariffs. So, there's a Mexico-Canada strategy that they're working on. There's a broader world strategy in terms of restructuring economic relationships and figuring out lessening the trade surplus. And then there's China. And I think the China discussion is the one that we've yet to have. And it's going to go to several different directions, whether it's, Trump going to China at first, trying to get a trade deal, and then going another direction. We don't know yet, but that's the one that's to come.
Leland, how do you think China views a potential trade war with the U.S.? Do they feel like they have leverage here, a position of strength? How do you think they view it?
They definitely don't have a position of strength, but I think they're in better position than they were last time around. I think all the announcements that we've heard for the last 6, 8 months from Beijing about bigger fiscal stimulus, more monetary firepower. There's a lot of people who've said, "Oh, look, big things are going to happen to the Chinese economy because of that." None of that has actually happened. If you look at this is all getting ready for a worst case scenario with Trump. And so they're ready to do bigger fiscal spending. They're ready to use the monetary spigots that they need to in a smaller way. We're not talking about the bazooka unless it's a break the glass emergency. And so they're getting ready. They haven't done much yet, but I think that they're prepared in a way they weren't last time if things get really bad.
Leland, I kind of look at some of these big Chinese technology stocks. I'll use Alibaba as an example, up 65% year to date. I use that as kind of a proxy for how Western investors look at China. Is there reason to be optimistic here about China, looking at a stock like Alibaba?
Well, I think you're right that that's how a lot of people use it. That wouldn't be my lens. I think that you could have a couple of companies in the tech sector doing really well, the DeepSeeks, the Alibabas, the Tencents, whatever it might be. And those stocks are going up and people are excited about AI proliferating around China. That has absolutely no correlation with broader stocks. And the broader stock market has no correlation whatsoever with the real economy. So you can see some companies doing better. I don't think that has anything to do with the Chinese economy writ large, even if investors want that to be a signal.
For you on your commute this morning across this nation, good morning, Canada as well. Leland Miller, China Beige Book, an extended conversation here, specifically trans-Pacific. On YouTube, good morning, good evening across the Pacific Rim. We're out at Bloomberg Podcast. Subscribe to Bloomberg Podcast. Leland Miller, educate us on the nonsense of bilateral art-make-a-deal negotiations. We are multilateral. I studied at the altar of William Klein at the Petersen Institute. Let's just take Vietnam. How does Vietnam fold into our nonsensical bilateral debates?
Well, I think by nonsensical, what you're referring to is the obsession by some over bilateral trade deficits. And the problem with that is you can have restrictions against one country, but what you're really worried about is what the grand totality of all the trade flows are. So if you have restrictions on China, and China's sending things to Vietnam, and Vietnam's sending to the United States, and it balances somehow, then that's much less of a worry than if you have a situation where you have a mounting trade surplus overall. So this is becoming very important because we're in an era of tariffs, we're in an era of transshipping around tariffs, we're in an issue in which the more we go at China, the more they're going to be setting up shop in third-party countries. So it's very important people understand that there shouldn't be too much of an obsession with bilateral trade flows. You can watch it, but it's the multilateral situation, the totality that's really important.
Leland, do you think President Xi would welcome a meeting with President Trump face-to-face to talk about broader trade issues, maybe just issues outside of economics? Is that something you think could happen in the next, 6 months or so?
Yeah, I know he'll welcome it because he's been sending signals to many of us in the business community here in the United States that they're all systems go. They want to talk. So yes, I think they want to talk very badly, but the preconditions on that will be you can't embarrass us, you can't surprise us. We need to know what's in store for the next 6 months so that President Xi doesn't walk into a trap. So there are preconditions on the meeting.
Leland Miller, I want to traipse delicately here, but I think it's an important conversation for this nation this morning. Trump 1 was a Lighthizer trade made out of the crucible of Robert Lighthizer's brutal childhood in Eastern Ohio. He saw Eastern Ohio crushed. What is Trump 2 trade theory compared to what it was in Trump 1?
Well, I think Trump trade theory is very similar. I think Trump trade practice is diverging a little bit from the theory so far. Look, the first term, it's correct. It was very different in a lot of ways than this Trump second term, in that Trump was constantly looking for victories. He renegotiated NAFTA, he renegotiated KORUS, he negotiated a trade deal with China. These were victories. He was using tariffs for the most part as negotiating leverage towards an outcome. The goal in the second term is very different, and markets have refused to believe this. They've maybe they do now with the market doing what it's doing, but the Trump administration and the president himself wants to restructure economic relationships in a lasting way. He wants to shift the whole paradigm, and so set up a wall around the United States, cut taxes for domestic manufacturers, and incentivize industries to come home. And so because of this, there is much more of an intention to go at all these different blocs and countries and go after trade surplus countries and try to right the economic relationship and bring some of these industries back home. So the idea is much bigger than Trump term one. This is something they want to leave a legacy on in terms of just redefining the way America does business around the world.
And Leland, is there a valid concern that some in the marketplace are reflecting today in asset prices that policy that you just articulated may result in slower economic growth and certainly higher inflation?
This is something that we've spoken about a lot. People are usually binary on this. If you put tariffs in place, it's a disaster. If you put tariffs in place, it's fantastic, and usually on two extremes. Neither of those is right. You can have tariffs in certain circumstances in different regimes, but you have to sequence them right. So you have to make sure that you're not going, if you don't want prices to rise, you have to have substitutability. If you want things to be gradual and there not to be a market reaction, then you can't go at rival production centers and hike tariffs, at both of them at the same time. You need to have an out. I think what's worrying markets right now is if Trump is really trying to have a trade policy that changes all these economic relationships around the world, especially via tariffs, there needs to be a place where it's a foundational place to build. And that has traditionally been the USMCA countries. It hasn't just been the United States.
Right.
I think some of this antagonism with Mexico and Canada has gotten people worried that prices are going to rise because you can't just bring everything home to the United States.
On the leakage, I sound like Steve Roach a million years ago. The externalities and the leakage out of a constructed Trump system of trade. Leland Miller, isn't the singular leakage diminished economic growth that one day flips to a deflationary or at least disinflationary vector?
I don't think anything is baked in. I think all of it's about having a strategy and then sequencing it right. So, if you look at the EU, everyone's panicked about how we're going to go to war with the EU. If this is done in a very sensible way, and the end result of this is that Germany is pressured into releasing its fiscal brakes. The EU spending more, it's defending itself more, it's funding more innovation, it has a broader capital markets union. People are going to be looking back in a couple of years and saying this is a net win for the United States and a net win for Europe. Now that doesn't mean how it's going to be executed it is going to work that way, but in theory, there's no necessarily bad outcome here.
Leland, thank you. Let's do it tomorrow. Leland Miller, China Beige Book. Greatly appreciated.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.